Hey everyone, welcome back to Corporate Decoder. Today we are going to unravel Highwire Network's latest SEC filing, which is so full of financial twists. It's like a high-stakes game of corporate Jenga, where one wrong move and the whole thing could come tumbling down. This filing outlines a proposed public offering, some serious financial juggling, and enough risk factors to make your head spin. But what does it all really mean for investors? Let's decode. If you like these deep dives, don't forget to subscribe and join our community on Discord. Link in the description. This document actually contains two prospectuses, one for a public offering of stock by Highwire Networks themselves, and another for existing shareholders to sell their shares. This is called a resale prospectus. Highwire is trying to raise about 4.5 million. Alright, so let's start with the basics. Highwire Networks is based in Nevada, and they operate out of Batavia, Illinois. Mark Porter is the CEO. As with any investment, there are risks involved. Highwire has a few big ones to watch out for. These risks range from their revenue growth potentially slowing down to substantial debt and relying heavily on third-party relationships. Understanding these risks is key before even considering investing. For example, they warn that their past revenue growth might not continue and could slow down. It's like saying, hey, we ran fast before, but don't expect us to keep up that pace. If their growth slows, that makes it harder for them to pay off their debts. Speaking of debt, it's a big concern. As of March of this year, they had over 4 million in debt, most of it due within a year. That's a lot of pressure, potentially limiting their flexibility and making them vulnerable to economic downturns. Also, they depend on relationships with other companies such as suppliers of products and services. What happens if those companies have problems? Highwire could feel the pinch. Okay, let's jump into those all-important financial statements. Here we can see the company's current financial snapshot. They had about $163,000 in cash, which increased to $5 million by issuing bonds, bringing the total to about $5.1 million. Their total stockholders' equity was actually a deficit of $3.7 million. Because they issued debt, it is now a positive number of $5 million. Overall, their total capitalization has seen some dramatic changes. It is important to mention that Highwire is a non-accelerated filer, meaning they are not required to file an independent audit. This offering will convert their old preferred shares to newer ones. The primary intended use of the funds raised in this offering is to expand their cybersecurity contracts to about 2.5 million, and the remaining will be used for working capital and general corporate purposes. Now, on to management's discussion and analysis. This section is where management really lays out their plan and tries to sell you on their vision. The company's revenue increased slightly for the 3 months ended March 31, 2025 compared to the same period of 2024, but their net loss was much higher, mostly driven by an increase in termination fees and debt amortization expense. It's clear that attracting and keeping skilled staff is critical to Highwire's competitive advantage. The company has offered preferential terms to large bondholders in the form of cumulative dividends. According to Grandview Research, the global cybersecurity market was $22.66 billion in 2023 and expected to grow at a CAGR of 12.3% through 2030. According to Chainalysis, in 2023, ransomware payments reached a record 1.1 billion DREAs. Their customers are mostly partners, not direct customers. They claim it's a better approach which enables them to leverage a smaller sales team. Their contracts are driven by master service agreements, or MSAs, which typically extend over multiple years. However, these MSAs can be cancelled by customers pretty easily. Now, back to those pesky risk factors. These are the things that could keep them up at night and derail their plans. One major point to note is that sales of their common stock may affect the market price. Another major point is that investors in the offering will experience immediate and substantial dilution. The company is competing in high growth markets, which is positive. They intend to grow revenues and market share through selective acquisitions and increase operating margins by continuing to leverage advanced automation technologies. Let's peek behind the curtain and see who's running the show. Mark Porter is the CEO and the board has 3 members. One of the directors, Peter Cruz, is considered independent under NASDAQ rules. Risk oversight is handled both by the board and its various committees, including ones for audit, compensation, and cybersecurity. Note again that Highwire is a non-accelerated filer, meaning they are not required to file an independent audit. Finally, it is key that all investors, both domestic and foreign, consult their own tax advisors prior to acquiring any of the company's securities to get a proper understanding of the tax implications. So what's the final verdict here? Highwire Networks is definitely operating in a growing cybersecurity market, and they're aiming for expansion and higher margins. However, that substantial debt load can become a significant headwind. Investors need to weigh these growth opportunities against the financial risks. This is not a financial advice. Make sure you do your due diligence and consult your financial advisor. Alright, that was our quick analysis of Highwire Networks' latest SEC filing. What do you think? Is this a company poised for growth, or is it too risky given its financial situation? I want to know. Hit that like button if you found this breakdown helpful, and subscribe for more corporate deep dives. Also, come join the community on Discord where we discuss these companies. The link is in the description. See you next time.